So, how do you, as an outsider, go into that type of environment at a time when banking was primarily all relationships compared to today, where you kind of compared it more to like a Chick-fil-A or a fast food service?
I had four people that I met with at least 3 or 4 times a month that were shareholders, but they were non-bankers. And if they would ask me, why do we do something? And I know you do this, I can see.
Thank you. I really appreciate that. It means a lot. Just kind of expanding on that competition piece. So, when you bought that first bank, it was in a town of less than 3,000. And I believe you said in your book that there were four other banks in town. So, how do you, as an outsider, go into that type of environment at a time when banking was primarily all relationships compared to today, where you kind of compared it more to like a Chick-fil-A or a fast food service? What was your strategy there to be able to break into that town and build the relationships needed to grow the bank?
Well, we had a twofold strategy. First of all, we were the largest bank in town, and that helps. Size matters. And secondly, our focus was in St. Louis. And I literally would drive 168 miles one way to work a lot of days and back that night. And we used that as a way to come to St. Louis and closed October. In January, I looked at a bank in St. Louis. By April or May, I had a contract and closed in August again. So it's really just most people, and you see this in the apartment world, they start from scratch. You build a new project and you lose money. You can't, you can't not. There were 6 banks that started in St. Louis the year before, and all 6 of them were startups. And I had all kinds of people come to me because I was in a great position where I was. And they said, why don't you start a bank? And I just couldn't do that, Raj, because you lose money for the first year, the second year, maybe you break even the third year. And literally, we paid a 10% premium to make money day one. So our first year, after tax, we made $360,000 on that $2,600,000. So we made, what's that, about a 14% return to our investors, where our peers, if they'd raised the same money, they would have. And the other thing is, when you start a bank, you can't borrow money. When you buy a bank, you can borrow money. So we have to introduce leverage. And you're in a business where managing leverage is important. And literally in those days, I can show you where you could lever a bank 42 to 1, which, would be the out there, but levering one 3 or 5 or 10 to 1 is pretty easy. And so we had those advantages that other people, we were making money day one. Now, we also inherited some problems because when you buy somebody else's business, you have some challenges. And I'll never forget, I went out, we had a loan, about a $9,800 loan. It was allegedly on a house. I thought it was on a house. So I pulled up and I went to this property, it had a gate, and I saw smoke coming out of the ground. And I walked up and literally this person had an underground dwelling without plumbing and without water. And that's when we changed the rules. If it was under 15,000, it was a place and not a house. But those aren't the kind of loans you would have made, but the person paid us. They were happy. It's just, there's some cultural differences, again, urban versus rural. But no, I would tell you those were fun years because we had the advantage of doing business in St. Louis because we'd gone through there'd been a recession. We didn't have problems. So we were out there making loans when other people were playing defense. And that's a lot of fun when you're always in a different position than your competitor.
So it's fair to say then that the timing of when you entered banking or as an entrepreneur helped with your growth?
Absolutely. And I had some really bright people around me, and I talk about this a lot in life. I had 4 people that I met with at least 3 or 4 times a month that were shareholders, but they were non-bankers. And if they would ask me, why do we do something? And I know you do this. I can see just in my little experience with you, I can see your culture's like this as well. If I ever said we did it because that's the way we always did it, we usually end up changing it. And I think that's wonderful because we talked before your show about complacency, and people get complacent, and complacency doesn't drive results. And over time, it really doesn't even drive survival because there's a point where after the law of diminishing returns sets in for so long, you're underwater and forget underperforming. And so they pushed me in that regard. The other thing is I had a woman in the group who had been an HR director for Mark Twain Banks. And we eventually passed. It was a great company with a lot of history and a very entrepreneurial company that started in the 60s. And she would interview key people that everyone who reported to me, the people who interacted with me. And this is what she taught me, Raj. And this is my lesson for you today and for your listeners. She said, first thing she taught me was, Sean, leopards don't change their spots and tigers don't change their stripes. Now, everybody can change a little bit. Maybe it's 5%, the best can change 10. But in a lot of relationships, and I'll use a personal analogy, people get into them and they think they can change their partner. Well, maybe a little, but not a lot. That leads to failures. So that was her first lesson. Her second lesson was, Sean, she'd come in and say, this guy Raj is bright. You're going to love working with him. You're going to get great results. But you're not going to like these 2 or 3 things. And she would say, you have to deal with those. You can't change him. Remember the leopards and tigers. You have to adjust yourself. Let him be who he is. Let him do that. Let him absorb our culture. And we'll come back to culture in a second. But you can't change him. So she taught me to suppress my will. And so many managers, owners, CEOs, entrepreneurs, they try to always push their will. Well, that can work in short periods of time. But when we had a 15-year horizon, you have to be the one as the chief culture carrier. That to me is what a CEO is you're the one who exudes a culture of what you want. And that's what, from the first time I met you, from I looked at your material, when I toured your facility today, you have a culture that this is what I know is making you successful, make you more successful. Because I've been in many of your competitors, their facilities, their offices, they don't have that. It's about culture. And so our culture was, Raj is going to come here, Raj is going to set the world on fire, but I have to be the one to absorb the change, because you can't change everybody. So you have to work on changing yourself when you deal with individuals. And that piece of advice has made me tens of millions of dollars. And I encourage people to look at the world that way.